Hello and welcome to the latest market update for the month of January with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. Well, it's been a while, Andrew, so had Christmas and New Year since our last market update, so how have you been?
Oh, I've been very well. It seems a long time since Christmas and the New Year's celebrations, isn't it?
Into February now, so the end of January. So how have the markets fared at the start of 2024? Is it a fresh start? Are we looking good?
Well, it's not been as bad as perhaps it might have been. We had a tremendous end to the year with finally the Muppets at the central bank saying that interest rates had peaked and some point in 2024 would start to fall. The markets got very excited by that news, and so much so that we hit new heights over the 2-year period in December. You would expect probably going into January you'd have a little bit of profit taking as people said, oh, well, actually, I made some money now, which is the first time in a long time. So markets did dip. And so overall, a lot of the funds that we look after fell in value slightly, though, ever so slightly in January. But there's some quite positive things out there, and we're expecting good things for 2024.
Why don't we start with the biggest economy in the world, in the US, and see how they fared in January, Andrew?
Yeah, so the US has shown again good growth. Not quite as good as it did in December, but nevertheless reasonably strong returns. Employment holding up very well. The number of job vacancies increasing, and with an unemployment rate of around about 3.7%. Most people think that that's almost full employment. The debt levels are getting amazingly high, though, and I think this is something that the world has got to be wary of, not only in the US, but here in Europe, and also over in the likes of Japan, where we've seen extraordinary levels of debt, which really can only be reduced if you start expanding the economy. Luckily, the US economy grew in the last quarter by 3.3%, helped by the tech stock, Nvidia and the Magnificent Seven. Came off the boil a wee bit during this month of January, but nevertheless showing quite impressive figures on some of the returns that we've witnessed in this month. The Federal Reserve saying that, well, yeah, we probably will look to reduce interest rates, but not quite yet. So markets had a bit of a slap down because they're impatient beggars. They expect inflation to fall, yeah, sort of just like that, and therefore bank base rate should fall just like that. But so the Federal Reserve keeping rates at between 5.25 and 5.5%, and probably we're not going to see a cut until probably May, June time of this year if things continue to go well. We increased the allocation to those funds within the portfolio to the US, and the reason being that they continue to be the world's dominant currency and country in terms of financial planning, and we need to have some of the action. So 2 or 3 of our good US funds did well during January, and we remain very confident that the US will be a good place for the next year, probably the next 5 or 10 years.
Good to see that the US is doing well, and how are our friends in Europe faring in the month of January?
Well, it was a good month, all in all, for the European funds that we recommend. Indeed, they were the highest performing sector. Funnily enough, have been the highest performing sector over the last 5 years, overtaking the US in many respects. So that's very, very good. Novo Nordisk, many people know that from the reviews we've had, if not using the drugs themselves, but they reached a valuation of $500 billion. So it's what a huge success story that's been. Inflation coming down in most areas. Spain pushed the button there. They actually went up, but their economy grew by more than estimated. So there's various pockets in Europe which are lagging behind, as always, because it's a fairly widespread, different number of economies out there that will each perform at different paces and do different things. So Germany still lags behind. Having said that, some of the big German companies have put some really good returns in. The difficulty is that exports are still down as the world starts to sort of get over the pandemic and then start getting back to normal. So there's not quite as much demand for a lot of the heavy goods and services and machinery that the Germans are famous for producing. But overall, the Eurozone was a good place to be invested in. And we've got a couple of good investment funds that we use there, so we're very, very positive on mainland Europe.
We'll travel a bit further afield and see how the Far East performed in January, Andrew.
Yeah, so again, mixed. Some areas there that did very, very well, great export numbers out. Japan slowed down a wee bit. That's probably the best of the Far Eastern countries. Last year, 2023, this year, a little bit of a slowdown as we would probably expect. Still have negative interest rates over in Japan land. That might come to an end this year, and it got the market a little bit excited, and they were hoping for that to come along. It probably will do, because negative interest rates really don't help anybody, as been proven here in Europe. If you have negative interest rates, the idea is it tries to stimulate the economy by saying, well, don't save your money, spend it and do things with it. China's still in the doldrums a wee bit, although the economy is growing about 4 times faster than the UK economy, so we'd love to have their challenges, but it's struggling with the amount of debt it's got. It's trying to stimulate the economy, but more people, I think more investment managers are moving away from China. All the geopolitical tensions you've got there between the US and China. So it's falling out of favour a little bit, but it's still a mighty powerful economy, and I suppose the political system there does mean that the government's able to switch things around very, very quickly, but still lagging behind in terms of where we thought it was going to be. But generally, over in that part of the world, there are some countries that are doing really, really well and benefiting. So good to have a foot in the equity markets in the Far East.
So we've been around the world and now we're back home. So in the UK, how we fare at home here?
Yeah, so the UK, well, we got a couple of surprises this month. Then that inflation increased. I don't know if that's a surprise too much, because generally inflation does go up in winter. I think we'll all know whenever we're going to the shops or filling up our vehicles, etc., it's getting more and more expensive. So yeah, it was an upward increase in inflation. A lot of people were quite surprised by that, but these things are going to happen. Long term, the rate is nudging downwards. It's not helped by the fact that people are getting higher wage rises, which is good for the workers, I think. But it actually means that when we compare the pre-COVID against current earning levels, earnings have actually risen above inflation, although perhaps we don't feel it that way when every news article seems to be doom and gloom, especially about the UK. The economy stuttered, stalled a little bit. We haven't gone into recession just yet. Not that means a great deal. Some good results out from a number of the companies that have delivered profits, but the big sort of one of the companies we've held for years and years and years, Diageo, in the doldrums because of the fact that people are not drinking as much, and also they're having troubles in South America, where they got into the tequila market in a big way. Now, I am personally trying to help them solve that challenge, but I think it needs more people to join me. You can only do so much, Andrew. You can only do so much. I try. The IMF, just the International Monetary Fund, who get it wrong more times than they get it right. They're predicting world economic growth will increase slightly more than they did 3 months ago. So they're saying the world economy will grow by about 3.1%. And they stuck their noses into the UK economy and said that, well, the UK government shouldn't reduce taxes anytime soon because we've got a huge burden of debt. The difficulty is if you don't reduce taxes, you don't stimulate the economy, you don't provide that growth which is needed to increase revenue. So, as we've said before, raising taxes short term, yes, it'll bring the money in. Long term, people look for schemes and reasons to avoid paying tax. So what you want to do is strike the balance between, yes, you want to deliver taxes that are needed to improve infrastructure, etc., but you also need to make sure that we have growth within the economy. House prices have actually held up fairly well in the UK, and indeed in Scotland have risen year on year. So a lot of reasons to be optimistic. The rate of unemployment hasn't increased dramatically. We're still under the European average by quite some way. And it's good to see that the UK smaller companies sector has done well this month. And two of our own smaller companies funds, one of them's now grown by 13% over the last 3 months. And we know going into the slowdown in the world economy that smaller companies tend to get hit first, and then they come out of any downturn last because of the fact they're waiting for consumer confidence to return, which is probably starting to happen now. So I think most clever people who are just as daft as you or I are saying that the UK and indeed Europe is undervalued in terms of sentiment and price. And there's a good case for saying that actually, yes, now is a good time to pick up assets in companies that are now considered to be fair value. So we're expecting, again, good things for the UK economy for this year, and we'll remain fully invested with that.
I guess finally we can enter into the fixed interest world, and how has that performed?
Yeah, we save the best till last.
Always.
So fixed interest, just another word for fixed interest, 2 words for debt, and yeah, it's starting to get back to behaving in a way that it did a number of years ago. We had some great sort of upheaval in 2022 with the arrival of inflation, and fixed interest really was the asset class you didn't want to get involved with at all. It was the most volatile, it lost you the most money over that period. It's starting to rebound now, and I think it will benefit once we get inflation firmly under control. Government debt, yeah, it's still a difficult area just because, especially in the UK, the interest rates that they're having to pay on UK debt still quite high comparative to where we've been for a number of years. So it's one of those areas that we will have some exposure to, but still a wee bit wary just because of the potential risks for inflation and government borrowing levels, the heights we've seen throughout the world. It is a little bit worrying, I think, the level of debt that's been racked up, which is sustainable if you're bringing good income in and you're getting economic growth. But for a lot of the world, they're not seeing the growth needed to actually bring the debt level down. And so it's, yeah, I think we still sort of have it as part of the portfolio, but it's going to take a wee while to recover. Certainly it's going to take a wee while to get back to the levels we saw pre-2022. So we treat it with some suspicion, and I think it's part of a portfolio, but not perhaps as easy to select as it was a number of years ago, because we've got a very good ride, partly because of the quantitative easing that was launched back in 2005 by Japan. So it gave us some returns that were perhaps out of all proportion to the risk and the return that were being achieved pre-2005 and quantitative easing.
Finally, we move to the A.R.D. Consultancy portfolio funds and their performance. And for the eagle-eyed out there, we've changed a little bit, and we've gone the performance over the 1 month period, 1 year period, 5 years, and 8 years. And this is due to a recent fund change that we did. So it goes to 8 years. And we'll start with the defensive portfolio.
So over the last month, the portfolio has fallen by 0.6%. Over the last year, positive 5%, 5 years up 21%, and 8 years up 45%.
And the cautious portfolio?
This month down 0.8%, over the last year up 4.8%, over 5 years 30%, and over 8 years up 65%.
And the balanced portfolio?
This month down 0.6%, over the last year up 5%, over the 5 year period up to 42%, and over 8 years up 89%.
The capital growth portfolio?
This month down 0.7%, over the year though up 5%, over 5 years 49%, and over 8 years 109%.
And finally the aggressive portfolio.
This month also down 0.6 of 1%, over the year up 5%, over the 5-year period 57% to the good, and finally 8 years up 129%.